a philosophy that we stick to regardless of what's going on in the world. But we are in the markets every day, and we can't ignore what's going on in the markets every day. And we do obviously position the portfolio, particularly when we're thinking about managing risk, to take account of the big picture. And I just thought I'd share a few points on the big picture for interest sake, and also I think to help people think about where you put capital today, how you might want to think about framing that. And to do that, sort of zooming out, I think the really important thing to understand today is that there's been two big developments that have driven most of the price action in global financial markets for the last 18 months or so. To sort of frame the picture, we need to rewind back to this time last year, the start of 2023. And if you recall, at that time, the world was a pretty bleak place, especially in financial markets. Coming out of COVID, inflation had come back with a vengeance, and to deal with that, central banks were aggressively hiking interest rates all around the world. Interest rates were going up at their fastest pace in over 40 years, fastest pace in a generation. In the US, probably the most important economy, the US Fed would hike interest rates by over 5%. Here in Australia, the RBA hiked by over 4%, and there were similar hikes of similar magnitudes all around the world. And, given interest rates had been so low for so long, shifts of that magnitude really represented a big shock to the economic system. So the consensus, the economic sort of forecast was a shock of that size, having had interest rates so low for so long, would lead to a nasty recession. At the same time, and I personally think this is a little unfair, but at the same time, the narrative in financial markets was that central banks had been a little bit asleep at the wheel. They'd let inflation get out of control coming out of COVID. They hadn't been paying close enough attention, and there was an enormous amount of political and social pressure on central banks to get the cost of living crisis under control. And you see that in the papers every day today still. So you had a situation where interest rates are going up very quickly. Central banks are more worried about containing inflation than they are about economic growth. And you can see the backdrop for why everyone was worried we would be going through, about this time, about now, 2024, a really nasty recession. Against that kind of bleak outlook, the real surprise has been this. Global share markets, as a proxy for kind of most higher risk assets, have had a tremendous run. From the start of last year to the end of April this year, global share markets, as measured by the MSCI index, are up nearly 30%. Now, over the long run, we should probably expect an asset class like shares to generate 7, 8, 9% a year, every year, annualised. So to move that far that quickly is quite a move, and particularly against the backdrop where we all thought, gosh, a nasty recession is coming, that's really quite a development. So what happened? Well, these two big themes that have gone on, and really two big shocks to financial markets. The first one's been artificial intelligence, AI, something that I'm sure you've all seen in the papers and people talking about a lot. And essentially, with the release of ChatGPT at the end of 2022, investors started to appreciate that the companies that go on to win the AI arms race, that get the market share in the dominant position, are poised to make enormous profits, a bit like the tech stocks of old and during the dot-com boom. And that kind of excitement for AI and AI stocks has pushed a small handful of technology companies, your Apples, your Amazon, names that you all know, dramatically higher. The navy line there represents what's come to be known as the Magnificent Seven. 7 ultra-large tech stocks in the US that investors are betting are the ones that are going to win the AI race. Now, just to sort of help shape the framework here, the dotted line at the bottom, the MSCI All Country Index, it's the most widely followed global share market index in the world. It has 1,400 companies in the index. The navy line at the top is 7 companies. It's less than half of 1% of that index, but they have been so strong, their performance has nearly doubled in the space of a year, that they've literally dragged the entire index higher. If you look at the bottom line now, that is the rest of the global share market, the other 1,393 companies out there. And you can see until about October of last year, they've really gone nowhere. If you haven't owned the artificial intelligence stocks throughout last year, especially for the first half and really towards this, till October, November of last year, global share markets had basically generated no return. And that's what you'd expect in an environment where we're worried about interest rates, inflation, and a looming recession. A higher risk asset class like share markets would naturally struggle. And this navy line at the bottom, unlike the AI stocks at the top, is much more exposed to the traditional economic cycle than the technology stocks. So they're much more exposed to that risk that I was talking about at the beginning, that a sharp rise in interest rates would really damage or dampen the economy.
Stay close to the mic. I'll
you do the pointing. Okay, forgot we're recording. That brings me on to the second shock, the other big kind of development in financial markets recently, and that's really been the US economy and how it's kind of astounded everyone at how strong it's continued to be. I'm going to show that here with two charts, hopefully. So this is data looking at the US economy, still by far the biggest and most important economy in the globe. The first chart here just shows interest rates in the US. And you can see, start of 2022, interest rates, like here and like most of the developed world, were basically zero. Money was basically free. Over the space of 22 and 23, you can see interest rates were progressively hiked very quickly, one of the fastest hiking cycles we've ever seen, to over 5.5% by sort of late 2023. Now this second chart here, I'll explain it. It takes a little bit of thought, but it's essentially what the market is expecting economic growth to be in the United States in 2024. So you've got teams of economists out there, teams of market forecasters, they're crunching all the numbers, they're coming up with their best guess of what economic growth is going to be like in 2024. And it measures that consensus estimate as we move through time. So you can see at the start of 2022, the navy line, and the scale for this is on the right-hand side. The start of 2022, the consensus estimate for US economic growth in 2024 was about 2%, which is about trend growth or about average growth for a large developed economy like the United States. And you can see, hopefully, if you look at the first half of the chart, as interest rates kept getting pushed up, the market's expectation for US growth in 2024 kept getting pushed lower and lower and lower, and it reached its zenith at exactly the same time that the Fed undertook its last hike in sort of the third quarter of last year. And that's kind of classic textbook economics. If you go back and look at the data and look at every developed market economy in the world since the Second World War, so a huge data set, and you look at what happened when interest rates were lifted by more than 4%, so a dramatic change, when inflation was already high, pretty much every economy goes into a nasty recession. So there were good reasons for economists to be worried for what was coming up. And you can certainly see that's what the market was pricing in. If you now look at the second half of the chart, from sort of October onwards, the real surprise has been the economic textbook has basically been thrown out the window. It has confounded all economists, all market participants. We're 2 years into probably the most aggressive hiking cycle in history in the US, and it's hard to see any real slowdown in the economy at all. It's absolutely amazing. The unemployment rate has been below 4% for over 2 consecutive years now. That hasn't happened in over 50 years. The labour market remains enormously strong. It keeps sucking workers in with high wages, strong demand, and that's kept house prices high, consumer spending strong. However you look at it, whatever kind of data point you want to get, economists have been resoundingly wrong for most of the last year. The economy in the US has just held up in a way that nobody expected. And you can see that now in the second part of the chart. Expectations for this year, 2024, have shot enormously higher. And, in a financial market context, that's really rare to see that kind of change in expectations in such a short period of time. It's kind of like driving down the freeway at 100 miles an hour and trying to do a handbrake UE. It's really rare to see. Basically, 6 months ago, the market was expecting a recession in the US, a couple of quarters of negative growth, a couple of quarters of positive growth gets you to a barely positive number, to now we're expecting the US economy to grow above trend, faster than its natural capacity. Really quite remarkable. Now, if you keep that image in your mind and you shoot back to the last chart, you can see that big change in expectations in the US corresponds with a big lift in markets for the non-AI parts of the markets in the second part of the year. So how come share markets have been so strong over the last little while? They've been dragged higher by artificial intelligence excitement, and then also a remarkable US economy that's really dragged the rest of the world along with it. Now that's all really exciting. Why does that matter? And what does it mean going forward from here? Well, it matters, in our view at least, because I think people need to appreciate that there's 2 very different engines that have been driving markets and will probably continue to drive markets for the foreseeable future. The first one is the AI revolution, and it's a tremendously exciting technology. It's a very high risk, high reward kind of investment space. But the success of those companies has been so big, so great, it has literally changed the makeup of global share markets. You now have a situation where those 7 companies, the Magnificent Seven, have a combined value of $12 trillion. That's bigger than the combined economies of Japan, Germany and the United Kingdom. They're absolutely enormous companies. And in becoming so big, they dominate the index in a way we haven't seen before. Today, those 7 companies make up 20% of the global share market index. So if you have an investment in an ETF or an investment fund that tracks that benchmark, and there's a lot of money that does, a very large part of your wealth today is tied up in what are high-risk, high-reward companies. And to call a spade, you know, a group of companies that can double in value in a year can certainly halve in value in a year. Now that might be perfectly fine for your circumstances in life, but I think it's very important to go into that with eyes wide open at the moment. If you're at a later part of your investing life, you can't afford a big capital drawdown, having a large amount of your wealth tied up in names like that is certainly something to pause and consider. The second thing, and I think this is something that's gotten us a bit exciting, is there's been a radical change. So that's driver number 1. You need to decide if AI is appropriate for you. I think the other drive has been this dramatic renaissance in expectations for the US economy and a dramatic kind of improvement in the basic economic fundamentals. It wasn't that long ago we were expecting a very nasty debt default cycle. We invest into the debt markets. It's a very big backbone for a lot of investors that generate yield. Debt default cycle coming because we're going into a nasty recession, or in the stock market, growth is going to slow enormously, company earnings are going to take a big hit. Everyone was geared up for that. I think the thing that we're very optimistic about is that in the more kind of traditional / boring parts of the old economy, the outlook is actually quite optimistic at the moment. We're certainly much more positive in terms of investing in the parts of the market we like to than we have been for some time. So I think that's kind of how we're seeing the big picture. 2 important drivers. One where we focus normally is in traditional economic stocks and bonds. The outlook's looking a lot better than it has for some time.